Okay, so let us go ahead and take on the another example under expected value method. I remember last video I did a sum on expected value method that read Venkatesh Limited. Now let us take on another example under expected value method. Okay.
Yes.
Now let us start with this example that reads Excel Industries. Yes, Renuka, read the question for us.
Excel Industries Limited designs and manufactures toys. Past experience indicates that the product life of a toy is 3 years.
3 years life for the product. Then
Promotional advertising produces an increase in sales in the early years, but there is a substantial sales decline in the final year of a toy's life.
you know, always there is, you all would have done something called the product life cycle. You know, when you introduce a product, then it grows in the market, then it matures, and start to decline, right?
Yes.
So since iPhone 16 is introduced, what iPhone 15, 14, there'll be a decline in the sales of those products. Fine.
Yes.
Yes.
So consumer demand for new toys placed on the market tends to fall in 3 classes.
Okay.
About 30% of the new toys sell well above expectation.
That means basically optimistic.
Yeah.
That is a 0.3 or 30% chance of sales being what?
New toys.
That is above
Expectation.
average, above expectation. Next.
And 60% sells as anticipated.
Basically, there's like a most likely 60% moderate. Next.
And 10% have poor customer acceptance.
So basically pessimistic, right?
Yes.
So it is 0.3, 0.6 and 0.1 or 30%, 60% and 10%. Next.
A new toy has been developed. The following sales projections were made by carefully evaluating the consumer demand.
Okay.
Now, consumer demand for a new toy, they've categorized into above average, average and below average.
Okay. Now,
and the probability of occurrence is given 0.3, 0.6, 0.1.
That's a repeat, already given. In fact, 0.3, 0.6 and 0.1 already given.
Yes. Above estimated sales in years, which is rupees in lakhs.
Rupees in lakhs.
So, for year 1, above average 12 lakh, average 7 lakh, below average 2 lakh.
So guys, remember the sales for the first year, optimistic 12 lakh.
12 lakh.
Most likely
7 lakh.
7 lakh. And then pessimistic
2 lakh.
2 lakh rupees. And for year 2,
it is 25 lakh, 17 lakh and 9 lakh.
Okay.
And for year 3, it is 6 lakh, 4 lakh and 1.5 lakh.
Okay. Then
variable costs are estimated at 30% of the selling price.
So variable cost is 30% of sales or selling price. That means I can say my contribution is 70% of sales, right?
Yes.
So variable cost is 30% of sales. Next.
Special machinery must be purchased at a cost of 8,60,000 rupees, which will be installed in an unused portion of the factory.
So 8,60,000 is supposed to be the capex, capital expenditure at time 0. I'm going to buy a machine for rupees 8,60,000 at time 0. Next. That is the initial outlay, O-U-T-L-A-Y. Okay.
Yes.
Next.
The company has been trying unsuccessfully for several years to rent out a vacant portion of the 50,000 rupees per year.
Yeah, so that means right now you have some empty space in the factory. So you have been trying to let out that portion for 50,000 rent, but you never found a tenant. So not an issue. Anyway, it's only a vacant space. Suppose the factory was right now, that space was let out and you've been earning how much? 50,000 per annum rent. And now you want to launch this product and use that space for manufacturing the toys. Then what? That 50,000 becomes an opportunity cost. But here, no. You never found a tenant. Right? Next.
Fixed expenses, excluding depreciation, are estimated at 50,000 per year.
Example what? All the salaries, right? And then other administrative expense, all cash expense. Is how much? 50,000 per annum. Next.
The new machinery will be depreciated by the written down value method at 25% with an estimated value of 1,10,000 at the end of third year.
You saw 8,60,000 on that 25% for the first year. For second year, what you'll do? From 8,60,000 minus the depreciation for the first year, and then on the balance, you'll calculate 25% because written down value method. You all know that, right?
Yes.
WDV method. Yes. And what is a salvage value after 3 years?
1,10,000.
You're going to sell this machine for rupees 1,10,000. Okay. Next.
Assume this is the only asset in the block.
Point not a block of asset. This is the only asset in the block.
Advertising and promotional expenses will be incurred uniformly and will total to rupees 1 lakh in the first year.
You will be spending rupees 1 lakh in the first year for advertisement. Second year, how much?
1,50,000 in the second year.
And year 3?
50,000 in the third year.
50,000 in the third year. You don't bother to spend much because anyway it's a dying product, right? Declining. So why spend extra money on advertisement? Next.
The company is subject to a corporate tax rate of 35%.
Tax rate 35%.
Its cost of capital is 10%.
They given 10% is the cost of funding the project, cost of capital. Nothing but WACC, weighted average cost of capital. Next.
It is assumed that no depreciation will be charged in the terminal year.
In the last year, that is in the third year, do not charge any depreciation on the machine. Instead, we find the short-term capital loss, right? You will not calculate depreciation in the terminal year, means when the project comes to an end, in this case 3 years. Next.
Requirement number 1. Prepare a schedule computing the probable sales of this new toy in each of the 3 years.
Calculate the expected sales for
3 years.
The 3 years.
Also determine NPV of the proposal. Number 2, assuming that cash flows occurs uniformly throughout each year, determine the net present value of the proposal. And number 3, give your recommendations in both the situations.
In both situations, okay.
Yeah.
I think they given the discount factors at 10%. Okay, that is what you know, very popular, 0.909, 0.826.
It's not given.
It's not there?
It's given.
It's given, right?
It's given.
So 0.909, 0.826,
and 0.5.
You all know these discount factors, right? But they given another set of discount factors in case the cash flows are
uniformly received throughout the year.
So 0.952,
0.864 and 0.783.
So people wonder, sir, how they got these numbers? What is the meaning? Don't bother now. I'll explain that later. Okay.
Yes.
Now let us focus on question number 1, where you have been asked to calculate the expected sales and also calculate the net present value of the project. That is, normal assumption is what? We assume always cash flow. Cash flows are generated at the end of each year. Okay, that's the assumption generally we make.
Yes.
Yes.
So calculation of probable sales. They made a chart.
They made a nice table.
Yeah. In that column number 1, consumer demand for new toy.
Okay.
Then next is the probability of occurrence.
Okay.
Next is the estimated sales for year 1, 2 and 3.
1, 2, 3.
Next, probable sales for year 1, 2 and 3. All are rupees in lakhs.
Okay. Now read for
year 1.
Year 1.
Yeah. Above average and probability 0.3, average 0.6, below average 0.1.
Okay.
Year 1 estimated sale is 12 lakh, 7 lakh, 2 lakh. And probable sales for year 1 is 3.6 lakh, 4.2 lakh and 0.2 lakh.
Nothing but rupees 12 lakh into 0.3. Guys, be ready with your calculator. Please do this. 12 lakh rupees into 0.3.
Yes,
and then 7 lakh rupees into 0.6.
Yes, sir.
Which is 4 lakh and 20,000. And 2 lakh, is it?
Yes, sir.
Into 0.1.
2 lakh
Right.
into 0.1.
20,000.
So adds up to 8 lakh.
In all, 8 lakh is expected sales, or I can say that it is supposed to be the weighted average. The average sales for first year is how much? 8 lakh. And for year 2, how much?
For year 2, Above average, it's 25 lakh. Average,
25
it
lakh
is,
into 0.3, which is 7 lakh and 50,000. Then
and for average, it is 17 lakh.
17 lakh into
Six.
0.6,
10
which is
lakh
10 lakh
20,000.
and 20,000.
Then 9 lakh in case of below average.
9 lakh into 0.1, how much? 90,000. Add up all the three.
18 lakh 60,000.
And that is expected sales for year 2. And for year 3, how much?
For year 3, it is 6 lakh, 4 lakh, 1.5 lakh.
It is 6 lakh.
4 lakh and 1.5
Okay.
lakh. And the probable sales is 1.8 lakh, 2.4 lakh and 0.1
In all.
15,000. Adds up to 4.35 lakhs.
4.35 lakh. Okay. This is your expected sales. Now that is one question answered. Where you have been asked to find the expected sales. But you got to make some more working notes. You got to calculate the depreciation for the first 2 years. Do not calculate depreciation for year 3 because very clearly given that no depreciation is charged in the terminal year, means in the 3rd year. In this example, 3rd year is a terminal year because that is the end of the project life. Is that fine?
Yes, sir.
Now just see, 8 lakh and 60,000, 25%, how much?
2 lakh 15,000.
Is the depreciation for the first year. Now for second year, what you should do? 8 lakh 60,000 minus 2 lakh and 15,000. How much? 8 lakh 60,000 minus 2 lakh and 15,000. You'll get around 6 lakh and 45,000.
Yes, sir.
On that, apply 25% depreciation. How much? The second year.
45 to 25% is 1,61,250.
That's it. Okay.
Yes.
And then do not calculate depreciation for year 3. Okay. My humble request, don't calculate because very clearly given in the question that no depreciation for year 3 because that's a terminal year. So then what I do with the 3rd year? What I should do? You have to bring your income tax knowledge. Okay. Now what is the opening balance for the 3rd year? At the beginning of year 3. What you can do from 8 lakh 60,000, you minus what? Depreciation for years 1 and 2, you subtract. What is the net amount?
4,83,750.
This is supposed to be the opening written down value of the block.
Yes.
And then there is no depreciation for that year. But this block is sold for 1 lakh and 10,000 rupees only. That means there is a loss of how much?
3,73,750.
This is a loss. But remember, loss is a non-cash item. You know that? When you incur a loss, you don't pay anyone.
Yes, sir.
You are selling the asset below its book value. That's it. It's only a paper loss. But this loss can be set off against some capital gain, thereby reducing a tax liability. So there will be a tax saving on the short-term loss. So on the short-term capital loss, how much amount? 3 lakh?
3,73,750.
On that, apply 35%. That's a tax savings on loss. How much?
1,30,812.
1,30,000, 130,812 is the tax savings on this loss, which is a cash inflow. I said no, dollar saved is dollar earned. Rupee saved is what? Rupee earned. Money not spent is what? Money in your pocket. Is that fine?
Yes.
Therefore, 1,30,000, how much?
800.
812. So do this working. So 3 workings are done, right?
Yes, sir.
We found the expected sales.
We found the
Then we found the
depreciation.
depreciation for
Then
2
tax
years.
savings on depreciation.
And so tax savings on the short-term capital loss. Now we are all set to find what? The CF 80. So you got columns, particulars, years 1, 2, 3. First line,
probable sales.
nothing but
8
expected
lakh.
sales, which is 8 lakh rupees.
18 lakh 60,000.
And then
4 lakh 35,000.
and then less under that all the
Variable
expenses
cost.
one by one. Variable cost 30% of sales, 2,40,000.
Depreciation 2 lakh 15,000.
Okay.
Then fixed cost 50,000.
No, you can read. Okay. So you'll finish up year one. Okay.
Yeah.
Then
Fixed cost 50,000. Then advertising expenses 1 lakh for year
1 lakh for year one. What is the
Adding up 6 lakh 5,000 is the total expenses.
okay? What is your profit before tax?
1 lakh 95,000.
Okay.
From that, tax is 35%.
35% tax is
58,250.
subtract. And then once again add back depreciation to find the CF80 for year one. How much?
3 lakh 41,750.
Okay, you can box this number. Okay, one number boxed. And then for year two, we'll work out now. 18 lakh and 60,000. On that 30%.
5 lakh 58,000.
And then depreciation.
1 lakh 61,250.
And then fixed expenses.
50,000. And
promotion.
advertisement 1 lakh 50,000.
That's it.
So profit before tax 9 lakh 40,750.
On that 35% tax,
Yeah.
you minus.
3 lakh 29,260.
What is the profit after tax?
6 lakh 11,487.
Again, add back what? Non-cash
Depreciation.
expense.
So 7 lakh 72,737.
That is a CF80 for year two.
Yes, sir.
Year three, just check. What is the sales?
4 lakh 35,000.
And then 30%.
1 lakh 30,500.
And then
Depreciation nil.
nil,
Fixed cost 50,000.
50,000.
Advertisement also 50,000.
50,000.
So 2 lakh 30,500.
Then what is your profit before tax?
2 lakh 4,500.
Okay. And then income tax at 35%.
71,575.
You minus it, you get profit after
Tax
taxation.
1 lakh 32,925.
Very good. Then there's nothing to add
Add
back
back
now.
depreciation.
Okay. This is a CF80 for year 3, should be right.
Yes, sir.
But there are 2 more cash inflows in year 3. At the end of year 3, there are 2 more cash inflows. One is he'll be selling the machine for rupees 1,10,000.
10,000 salvage value.
You will sell that machine, okay,
Yes.
for rupees 1,10,000. That's a cash inflow. And also there'll be a tax
Savings on
savings on short-term capital loss, 1,30,812. Okay, rupees 1,30,812 is a tax savings on short-term capital loss. Even those are cash inflows. But those two are only at the end of year 3 anyway, right?
Yes.
Now what are you going to do? You can find the total. How much?
3 lakh 73,737.
Including what? The salvage value and the tax savings on short-term capital loss all put together, right?
Yes, sir.
Now what do? Place the discount factors. 0.9. Normally this assumption. We assume the cash flow occur at the end of each year. So into 0.909, then into 0.826, and into 0.751. Now how much you get in the present value for year 1?
3 lakh 10,651.
And year 2?
6 lakh 38,281.
And then year 3?
2 lakh 80,676.
Adding up all the 3?
12 lakh 29,608.
From this you minus the initial outlay rupees 8,60,000, the amount as spent on the machine. Now what is a positive NPV?
3 lakh 69,608.
That is a net present value of the project. Okay, so let us now go ahead and take on the second subdivision. Now where you have been asked to calculate the net present value of the project when the cash flows are earned uniformly through the year. Now in the question they given the discount factors when the cash flows are earned uniformly through the year. It's given as point how much? 952.
0.864.
864.
And 0.83.
And
783, sorry.
783. These are the discount factors given. Now we can take those discount factors and calculate. Now once I complete the discussion for subdivision 2, then I'll tell you what are the discount factors are not given, then how do you compute? Okay.
Yes.
So right now, let us go ahead and take on the second subdivision, the solution to that part.
Year 1,
Now, what is a year 1 cash flow? 3 lakh?
3,41,750.
That into 0.952, not an issue. Okay.
Yes.
And then for what is a year 2 cash inflow?
7,72,737.
And that into 0.864.
4.
And then we'll go to the
Year 3,
year 3, the third year. What is a cash flow for the third year?
1,32,925.
Exactly. Take that and don't take including salvage value and the tax savings on short-term loss. Okay, the short-term capital loss. There's a reason for it. So these are cash flows from the business, right?
Yes,
From selling the product. That is uniformly through the year. So take 1 lakh, how much?
32,925.
That into 0.78.
783.
So present value, all these are cash inflows. But point to note that 1,10,000 rupees and 1,30,812 cannot flow uniformly through the year. Yes or no?
Yes, sir.
Because you'll be selling the asset when?
End of the
At the end of year 3. At the end of year 3, when you sell the asset, you will suffer a loss on which you're going to enjoy a tax saving. Therefore, take the 1,10,000 into 0.751, the end of year 3 discount factor at 10%. And also 1,30,812 into 0.751. Is that clear?
Yes, sir.
Now, how much you get? 1,10,000 into 0.751
And 1,30,000
into 0.751.
So 82,610 and 98,240.
Then add up all the cash inflows present value.
12,77,921.
Minus initial outlay 8,60,000. So what is the net present value?
4,17,912 positive.
It is still positive, right?
Yeah.
Good. Then
Suggestion. Since NPV is positive in both situations,
both the situation.
it is suggested to take up the project.
Obvious, right? Positive NP means what? Your PV of inflows are more than, the benefits are more than the cost. Therefore, you should go ahead with the project. Is that clear?
Yes, sir.
Now, suppose the discount factors are not given when the cash flows are earned uniformly through the year, then how would you calculate the discount factors? What you can do is, now you all know that, no? For year 0, always what is the discount factor? 1 rupee. Now we know that end of year 1, what is the discount factor? 0.909. What you can do, you can just show this working. Okay.
Yes.
So 1 plus 0.909 by 2. You may not get exactly 0.952, you'll get 0.95, say 5. That's okay. So 0.952 or 955, that's fine. And then how to find the year 2 discount factor? Again, take an average discount factor, 0.909, that is the end of first year, plus 0.826 end of second year, and take an average by 2. And what about the third year? You can take 0.826, and then third year is 0.751, add both by 2 average. Okay?
Yes, sir.
So you will get the discount factors that should be applied on the cash flows. In case you have been asked to assume that cash flows are generated uniformly through the year. Is that fine?
Yes, sir.
But I'm sure they'll give the discount factors in the question paper itself, not an issue. Is that clear?
Yes, sir.
Okay, guys, go through this example. Okay, it's a very important sum. Just go through this. So good luck for your examination. Bye-bye.